Hi everybody, this is Patrick Zielbauer from Infinity Futures. Thanks for taking a look at our YouTube channel. I wanted to give you just a quick update. We had a lot of questions come through recently about spread margin, pairs trading. This is a aspect of our service that we are going to be improving and putting out more resources for, so stay tuned. But in the meantime, some of our clients did ask us for updated figures on some of the exchange recognized spread and maintenance margins. And so I did put together a document, and I put a chart on the screen here. I just want to give you a quick explanation of what we're talking about. So this chart here, this main window, is the spread between the 30-year bond, which you also see here on the left, and the ultra bond, which you see here in the bottom left. So if you take this chart here, this value, and subtract this value, then that yields this value here. So that's what this line represents. It's actually tracking the spread value, not the value of an underlying commodity, or in this case, interest rate futures contract. So when people put these types of trades on, there's two ways that the firm they're trading with can handle the margin requirements. One way is to charge the customer a margin requirement that is basically the sum of both contracts. So you're in a bond position, you're in an ultra bond position. What's the margin on those two contracts put together? It's going to be in the neighborhood of $10,000. The other way is to allow the customer a discounted margin because the exchange recognizes that being long and short these two markets in most cases represents less risk. Not all cases. There are cases where spread trading can actually increase your risk, but it is true that the CME does offer a discounted margin requirement for a large amount of correlated pairs trades. So here's an example of what we're looking at. Now these were all calculated today, and this information, I believe this to be accurate, but there might be some imperfections here, so be conscious of that. But there's this is a list of some of the common spreads and maintenance margin requirements that our clients are asking us about. So as an example, this ZB minus UB position has a maintenance margin overnight of $1,538. All right, that's pretty low. So if you're wondering, well, wait a second, if the margin requirement at the other broker is over $10,000, why is that? That's because they're not recognizing that the exchange offers a discount on this paired trade. So it's not like these values are close. It's not like we're asking for $1,500 and they're asking for $2,200, right? They're asking for, in many cases, over $10,000. It's not even close. So if you're trading futures with a firm that sort of treats futures like a side project, where it's very clearly not the majority of what they're doing, odds are you're going to see this type of inflexibility and likely other inflexibilities as well. So part of our position in general is that if you're going to trade futures, especially trading this way, work with a firm who specializes and will give you the benefit of the exchange recognized margin. So this is a current list. If anybody wants a copy of it, just email your rep in our office. We'll be happy to take care of it for you. My name is Patrick Zielbauer. Thank you for listening. Have a great day.